All right. So let's talk Gotham. So, ooh, is this going to work here? Nope. Oh, sorry, you guys. Okay, give me one quick second. Just when I thought this was working, it's not. So let me try one other thing here. Okay. So unfortunately, I'm not able to. All right. Sorry, you guys. This is the technology glitch here. Um, Let me share my screen again. Okay. Can everyone see my screen again now? Perfect. All right. Apologies for this. So it looks like I can't seem to get this in full screen and get everything to function properly. So we're going to do this a little bit differently. Um, so a few things just in terms of the review, right? We talked about costs of goods sold or COGS, right? Which in this case refers to the inventory, which is the meals that they freeze and then sell the next month. And COGS is referencing that inventory that the business has sold during a particular period. And then using matching principle, right? This is under the generally accepted accounting principles requires that your accountants and the presentation of financials records both the sales as well as the expenses that allows those sales to happen in the same accounting period, right? And so this was part of um, what's expected in the Gotham case is for you to make sure that you match those things up. And we did a lot of work together on that last week. So I just want to make sure everyone's lined up on matching principle because that's an important component of this case and quite honestly, important component of the course. As you understand this, it's again a way of deepening your understanding of how to read and interpret your financial information that you're reviewing. So why is matching principle important? Why would that be a requirement under the general accepted accounting principles? Why would we prepare um, financial statements to ensure that the matching principle is being followed? Can someone offer some thoughts on that? Harry, what do you think?
I would think because it's more tangible and it's kind of aggregating numbers that are real rather than projections or money like restricted dollars that we will have access to or something. It's like a realistic snapshot of money moving in and out.
Right. Yeah. So the intent, right, behind this is that for the investor that is reviewing the financial information, or in the nonprofit space, maybe it's a community member, maybe it is a banker, maybe it's a funder, um, whomever it might be, maybe it's a board member. What the matching principle does is create the highest level of accuracy on the income statement in terms of the revenues that were earned in a given period and the expenses that allowed those revenues to be earned, right? If you don't do that, then you're going to have a big mismatch in terms of the bottom line impact, right? Imagine you recognize all your expenses in the month that you froze the meals and all of the revenues, but just the revenues and not the associated expenses when you sell it. What's going to happen on the income statement is you're going to show big losses in one month and big profits in the other month. And that's not giving a true or clear depiction of how the business is performing, right? So part of the purpose behind this principle is to make sure that there's a clear presentation of how the business is performing. Good. Any questions on that? Okay, hold on for one more second here. Awesome. Okay, so let me go to the next slide. See if this works. Oh, actually, I can't go to the next slide, so hold on. So as we move now into Gotham case, what is the main issue Mr. McCall is facing? What's the biggest challenge when you look at the financials and look at the projections? What's the big issue that McCall is facing? What's the problem here? Yes, Sumaya.
One thing our group found was just a strong lack of liquidity, and that resulting in a negative cash flow over time.
Absolutely. So, liquidity issue, loss of cash flow. Gabe, do you remember exactly in what month that it becomes a big issue?
April.
In April. What happens in April?
So in April, I'm looking at the math. So in April, uh, from all the cash payments and also still awaiting whatever is due to them as well, they go into a negative 3,850 ending cash balance.
Right. So they effectively run out of cash in April. Now, here's another question. This is one of the things I think makes Gotham so interesting. Carly, are they profitable?
Yes, which
Yeah.
is weird because, they don't have any cash.
It is weird. So someone explain to me, how is it, and think of the case and the work that you did on the case, how is it possible that an organization can be profitable as demonstrated on the income statement and yet at the same time run out of cash as shown in the statement of cash flows and also on the balance sheet? How can both those things be true? Harry.
I think it was also said in the readings for this week, but profit is not a great metric for, sort of the health of business operations, because it can be, there's a bunch of things you can do to sort of modify, like make it look better than it actually is, whereas cash flow is sort of really the nuts and bolts of the health. And in this case, the cash flow issues are driven by the accounts receivable. So like the fact that the organization isn't collecting the actual payment until 2 months after delivery.
60 days. Yep.
And so it's creating all sorts of downstream cash flow issues for the organization. And yeah, so basically you can't spin bad cash flow.
Right. So,
yeah.
Harry, thank you for that. So, absolutely, when you look at the nuts and bolts of the business, as Harry referenced, you may have heard the phrase "cash is king." This is exactly true, right? You cannot continue to run a business if you don't have the cash. So, cash is critical. But there are some interesting things happening on the income statement, because the income statement is showing that the business is profitable. So again, Harry sort of pointed to the reason behind it. Can someone in their own words also explain, why are they profitable but running out of cash? Same question, just explain it a little bit differently, building upon what Harry shared. Dong, do you want to give that a try?
I think it's the timing of getting the cash in. So they getting late for 60 days to get the cash for this month. So they're waiting to cash to be coming in the future.
They're waiting for a long time to cash in the future, right? So again, under the generally accepted accounting principles, and this is the point I want to make sure that everyone in this Zoom meeting understands, is that you're still booking the revenues in the month that they were earned, regardless of whether you are collecting the cash in that month. And that is the reason why the income statement shows the profit, is that you're recognizing the revenue that's in. That's showing up on the income statement, but you're not recognizing the cash that's in. right? Per accrual accounting, the sources and the uses of cash is reconciled through the statement of cash flows, and then it shows up on the balance sheet. So the main thing is, because this is something that sometimes gets lost, when you're looking at an accrual-based income statement, that is not cash in and cash out. That is revenue in and expenses out. And those are two different things. Does anyone have any questions about that? Because that is a critical piece. I want to make sure folks understand. Like one core lesson learned from this course, if it's not already clear. So if you have questions about it, this is a great time to ask. And by the way, this is the space to ask anything you ever wanted to ask about finance. It's a safe place to do so. Is everyone good?
I have a question.
Yep.
So what you just said, it means that in the balance sheet, in our case, in accounts receivable is where we would see the actual profit, right? Is that where we would see how much we earn?
Nope. The profits show up on the income statement. But what the income statement is not showing is how much cash has come in or come out. What it's tracking is the revenue that's been earned and the expenses that have been incurred. But revenue earned is not the same thing as cash in. Let's run with that thread for a quick second. What do I mean, Kobe? Maybe you can answer this. When I say revenue does not equal cash in, expenses do not equal cash out under accrual accounting. Are you able to translate that into English?
So revenue does not. Can you repeat it again?
Let's just start with the first part. Let's look at the top line. Revenue does not equal cash in under accrual accounting. What does that mean? Can you just translate that into kind of plain English, if you will?
Revenue. Well, your revenue can come from multiple different sources, and some of those cannot only be cash. So there's different streams of revenue. So that's what I would assume.
Okay, good. So let's build off of that, right? Because what Harry mentioned earlier, and Thong as well, is the accounts receivable, right? So we're recognizing the revenue that's been earned, but if the cash hasn't come in, then you're booking it as accounts receivable, which, Sumaya, is what? What's accounts receivable? Again, just in sort of simple.
It's like unpaid invoices that you've invoiced your customers with.
Yeah, it's what you're owed. It's what others owe you, right? So on the income statement, we are tracking revenue, not only cash that's in, but also revenue that's owed to you but hasn't been paid yet. That's the key point. I want to make sure everyone's lined up on that, right? And that is why the business is profitable, but running out of cash. Barbara, does that help? Is there any follow-up question on that?
No, all clear. Thank you.
Okay. And then, so on the expense side, it's a similar story, right? I mean, you could really summarize accrual accounting into it includes receivables and payables, right? So just as with revenues, you have accounts receivable or revenues that have been earned, but you haven't received the cash. On the expense side, and Gotham doesn't go into this, but on the expense side, you may have incurred expenses that you haven't yet paid out. So in that case, it's the inverse, right? You're holding on to cash longer, but you still owe those vendors money, right? So this is where, reading and interpreting the financial statements, understanding some of the principles of accrual accounting becomes so important. Because again, I want to tie this back to what Harry led off with, which is so incredibly important, is the nuts and the bolts of the business are driven by cash. You have to be on top of and tracking your cash, right? You've heard me mention, I've worked in a nonprofit that it was sitting on 4 days of cash on hand. What does 4 days of cash on hand mean? That's on Monday, I know I'm running out of cash on Friday, right? So all of the energy and effort is to how to convert those revenues into cash as quickly as possible. And in a very practical way, what did I do? How did I do that? I got all of my accountants together and all of my AP, anybody who was sending out invoices, to say, turn that around as quickly as possible. Email, call, reach out to your vet to our payers and get the money in as quickly as we can. That's literally what we were doing. We were trying to turn around our accounts receivable as quickly as we possibly could because cash was so tight. Once you get to about maybe 75 or certainly up to 90 days of cash on hand, that becomes less of a concern, generally speaking. You're able to sort of manage the variability of cash coming in. But if you're sitting on 4 days, that's where you really have to become aggressive to work those accounts receivable. Gabe, you have a question?
Yeah, I was thinking that same thing you just described, but I'm also thinking on the flip side too, where what if the people can't pay the invoices in time? Or like, let's say you're in a credit situation, just like what if like those people end up defaulting and you don't receive any payment for the next month?
Those are some of the things you have to manage. So that's actually a really good segue into the question that normally I presented, but tonight I'm not able to do that. So let me just ask you while we're looking at this slide, what are recognizing the issue that McCall has, which is they're running out of cash. Despite being profitable, they're running out of cash. So what are some of the options available? How do you manage that? It gets to Gabe's question as well. And there's a lot of different levers you can pull. Someone give me one.
Send invoices right away
Send your invoices right away, right? Did anyone
with
model
the
that out,
order.
by the way?
Sorry?
Did anybody model that out, by the way? Because that's the power of the model as well. Harry, you modeled it out. And if you send the invoices right away, so you're dropping your accounts receivable from 60 to 30 days, does that solve the cash flow challenge?
Yes, it does, and it gives you pretty significant buffer at the end of September of that year if they had have had that the whole way through.
Right.
So it solved the cash flow balances pretty much straight away.
Right. So this is where financial modeling can be really powerful, right? Is you start to really see and understand some levers that are available. So that's one option, right? They instead of waiting a month to bill, they bill right away. Absolutely. What are some other options that are available? Maddie, what do you think? Okay, I'm passing on Maddie. Claire, your thoughts?
Hi. One of the thoughts that I had was we could like slow down growth. Like they're growing at a very, very large rate.
Absolutely, right? And so again, this is where the modeling comes in handy, assuming that you did it the same way that we covered last week in class, right? The growth rate is 250 meals each month. If you slow that down, if you cut it in half, right, what's the impact there? That is certainly going to help cash flow. So you can slow growth. Absolutely. Thong, I see your hands up.
Yeah, I think one way we can think of is we can prolong the money we pay for the inventory for the supplier.
Absolutely, right? So this is, right? So, we can collect our receivables faster, but we also don't have to pay our suppliers in the same month that we receive the goods, right? Maybe they can sit on their accounts receivable for 30 days when we pay them. And by the way, if they're sitting on accounts receivable, what happens on our balance sheet if we're not paying them in that month? What liability goes up? Does anyone remember what the line item's called? That would be accounts payable, right? Which is basically saying what Gotham owes others, right? But hasn't yet paid. What else? What are some other options that are available?
We talked about fundraising as an option.
Yep. Great. Gabriella, tell me a little bit more. That's absolutely on point.
When we modeled it out, we saw that they would probably need to raise about $11,000 in like Q3 until if they wanted to keep the 60-day accounts receivable kind of timeline, they would kind of need $11,000 in the next quarter to float them until the cash started flowing in a way that was sustainable for them.
Right. So this is really important too, and this is a lever that only as a nonprofit really you're able to pull is through the charitable contributions, right? So they got that initial $25,000 grant, and again, I deviated from the case a little bit and asked you to assume that the cash comes in October as compared to already showing up on the balance sheet because it just I think creates a clearer presentation for nonprofits and how it works. But if they did more fundraising, if they got another 25,000 or 50,000 grant, or even maybe a little bit less, per what Gabriella was saying, that's going to make a big difference as well, assuming that the grant is showing up as cash in those months. And that same organization that I worked with as CFO that was sitting on 4 days of cash on hand, in addition to the invoicing, that was another thing that we did was we went to our funders and said, I know we've got the commitment. Can we get the funding in now? Right. So those are some of the other levers. What else? Did anybody have other options available? Samaya.
We also, I'm in Gabriella's group, but we also talked about the potential of a bulk discount, like negotiating a bulk discount with a supplier to lower the COGS. And like it doesn't have to be even for every order, but just orders over 1,000, for example, 1,000 units, for example, even dropping by 50 cents makes a huge difference over time.
Absolutely. And I like how you presented it that way, which is we're reducing expenses, but basically getting a discount based on the bulk purchases, right? So it's not like we're sacrificing quality in any way. We're just saying, hey, look, we're buying this many. Can you give us a discount? And that could have a positive impact on cash flows as well, right? Anything else?
Yeah, but like residential class flop here, but I thought that why don't they just stop? Like stop producing, stop getting new people, stop digging your hole bigger. But also, I don't know, I'm not a financial wizard, but it crossed my mind.
No, you're on the right point. And someone mentioned this earlier where Venus, let me just translate that as slowing down the growth rate, right? So, maybe they flatline for a period of time because they're having trouble managing their cash flows. Because on the one hand, like the most obvious thing to do is to send the invoice in the same month. But given who your population is, maybe they still need 60 days. Maybe you're not able to move it up into 30 days, right? So there might be other things that you need to do. Slowing the growth rate is one, right? Reducing costs is another. Investing in fundraising is another one. One other option that's available. Oh, Bruce.
Taking out a loan.
Yeah, that's where I was going. Were you thinking line of credit? Is that where you were headed, Bruce?
Yeah, to get an initial influx of more cash to just manage the in-between.
Absolutely. Right. So a line of credit is a really useful tool for nonprofits to manage cash flow challenges. A line of credit is a specific loan product. And part of the requirement of a line of credit is that they have what's called a 30-day cleanup period. What the 30-day cleanup period means is that you are required to maintain a zero balance for 30 consecutive days. The reason why the banks do that is because they want to make sure that you're using the line of credit to manage short-term cash flow challenges and not as a long-term debt instrument. If you're not able to maintain the 30 days cleanup, oftentimes what the banks will do is restructure your debt. They're probably not going to default. Banks generally don't like to default on nonprofits. That's not helpful to their image or perception, but they might restructure the debt into some kind of term loan. But a line of credit is really powerful. And for nonprofits that don't have it, that are in good financial standing, they should get it while they're in good financial standing. Typically, it's run through their primary banking relationship. And it generally works like this. Like, for example, at Lifelong, we had a, hold on. Yeah, we got a $5 million line of credit. And the annual fee of that $5 million line of credit was 0.25%. So what that means is it costs us about $12,500 a year, approximately, to have access to 5 million, right? So that's a pretty good deal, right? And you're only paying interest on the money that you draw down for the period that you've drawn it down. But in terms of managing cash flows, right, sometimes you have nonprofit leaders who are debt averse. And I don't think there's necessarily anything wrong with that. But there are indeed some loan products that can be very beneficial, right? So let's say it's not 5 million, Lifelong's a larger organization. If it's $1 million, a quarter of 1% means $2,500 a year to have access to $1 million. That to me is worth the money. Spend $2,500. Typically they have, it's like a renewal fee. Sometimes, there's different ways that banks set it up, but that's generally speaking what you're going to get charged. So to pay $2,500 to have access to $1 million, to manage cash flows, in a time where there's uncertainty, it's useful to do it. And again, you want to be proactive and do it when the organization's in good financial standing as compared to when they're struggling. It's going to be harder to get a loan that way. Harry, did you have your hand up?
Oh, I was just going to literally ask that. What happens if you're scrambling at the last minute and you need that facility? The term's obviously going to be way worse. Is that what usually happens?
Well, so the the actual process of acquiring the loan will take time, especially with the more traditional banks. So you have to factor that in. There are loan funds out there. Sometimes they're run through foundations. Sometimes they're run through CDFIs. Are folks familiar with CDFIs, Community Development Financial Institutions? So these are basically like quasi banks for the social sector. And so sometimes you can get, those entities to move a little bit more quickly. But as a best practice, and for anyone who's on a board or maybe in the future is on a board, or you're an executive at a nonprofit, get the line of credit. There's just very limited downside to it. And that enhances your liquidity. So just kind of bringing this one home here. So here are the options. And I think we've covered just about all of these, right? Oh, we didn't talk about the increasing price. That would be something else that they could do. But you could certainly lower costs. And I really like how that was described. Now I forget who said it, but is basically saying, look, we are increasing the volume of inventory every single month. Let's get some bulk pricing on that. I think that's a very wise way of describing it. Reduce the fixed monthly expenses. That's another way of lowering costs to the extent that you can do it. Speeding up collections of accounts receivable is probably the most obvious. Bruce, you have a question?
Yeah, just curious about the line of credit and CDFIs. Like, do you just have like a savings account at like Chase, or do you have like credit union? Is it supposed to be more community based? Like, what are the different organizations where like you store the money, you get loans and different things like that?
Right. So I think you're going to see a pretty wide variety among different nonprofits. In my experience with the nonprofits where I've worked is, it's mostly been, both regional and national banks. So, whether you're looking at, Bank of Marin or Fremont Bank, or Lifelong used US Bank. And then prior to that, they had Union, Wells Fargo. And then in terms of the loan products, that's kind of a separate conversation for another time. But generally speaking, you're going to shop it around. But you definitely want to give your primary banking relationship a first bite of that apple and see what they come up with. Gabe?
On a similar question to Bruce, so say a nonprofit puts their money into a savings account with a bank, and whatever compounded interest is received, are there any like tax exemptions that savings interest rate or those earnings get, or are they taxed normally?
Boy, you know what? That's a good question. I'd have to get back to you on that. That's really interesting. I'm not aware of being taxed. So for example, Lifelong gets a bunch of investment income. Let me double check on that. I don't think there is necessarily tax implication on that, although if you're selling stocks, I guess there would be. Let me Gabe, let me get back to you on that, just to make sure I'm giving you a clear and accurate answer on that. Just going through the rest of these. So we talked about the speed up collections of receivables. We talked about slowing the growth rate. We talked about basically incurring the short-term liabilities through accounts payable. So not paying the suppliers in the same month, but paying them in the subsequent month, right? Another option is the line of credit, which we discussed, and fundraising. So that's the Gotham case, you guys. And again, just to tie this up in a little bow, right? The purpose behind Gotham ultimately is to help deepen your understanding of how these three financial statements interact with each other. I think there's some real value in working through the build of those financial statements. The deeper you understand the mechanics behind how they're built, it's inevitably going to help you with the reading and interpretation, which is really the main point, right? I want all of you, when an audit comes across your desk, when an income statement comes across the desk, when a balance sheet comes across your desk, that you know what it means and you know where to look. And so hopefully this was a good step in that direction. Any final questions on Gotham? Gabe?
Not necessarily on the content, but just curious on how you're gonna grade us on it. Like if we completed everything, have all the formulas, answered all the questions, is that full marks, or is it more so on the quality of the answers as well?
Yeah, no, you would get full marks on it. So I do have a grading rubric. The majority, so out of 15 points, 10 points is tied to the Excel spreadsheet, right? And then it's what's the core problem, and then the options that are available. And the only place, so you have to have completed the Excel spreadsheet correctly. Most students will get majority credit on that. But I will grade within the next couple of weeks. And if there's hopefully I'll get back to you next week. If there's any questions on the grade, let me know. But typically, students do pretty well on Gotham case. Sometimes there's a point or two that gets missed just because it's, like literally when the options are available, you could bullet point out what you're seeing here, and that would be acceptable. Sometimes if there's a point taken off, it's only because there's one option, when the truth is, I'm looking for at least two or three. Does that help? Okay.
I have a question as well, if
Yeah.
that's okay. So with the information that we had on the case, and also all of us, I guess, identified all of these options, at least two or three.
Yeah.
What, in your opinion, with a case like this, is there one of the options that is better or more advisable than another one?
In this particular case, I could make an argument for any of these. In my mind, the most obvious one is to speed up the collections of an AR. Like as you start, because in part when you're working through the Excel spreadsheet, that's the issue that always jumps out. It's like, gosh, if they just could do it 30 days sooner, that would make all of the difference. But the reality is anything that's going to solve for their cash flow problems is a good solution, right? And then, this is an academic exercise, right? Real world is far more complex. And you could imagine for a moment, like, yes, speeding up AR is the obvious thing to do, but based on the population that we're serving, there would be no way to do that. So then what are the other options that are available? And so you kind of work through those different levers.
Thank you.
You bet. Okay. All right. I've got some really boring stuff I want to share with you, but we'll go through it relatively efficiently, I hope. So I do want to talk about the audit in the IRS Form 990. Some of this will benefit the ACCI case study, which we'll talk about after the break. These are two financial statements that are public facing. The IRS Form 990 is something that's readily available, although it's typically about 18 months delayed. Have folks been on ProPublica or GuideStar? Has anyone been on those? Right? There's a specific reason. Gabrielle, I see your hand went up. There's usually a specific reason why people go onto the 990 in particular. And that is it shows you the top highest paid compensated employees. So if you want to know what people make at nonprofits, that's publicly available information. So the IRS Form 990, that's a tax return. But the websites that are available, ProPublica seems to be the space that I'm going to more these days as compared to GuideStar. It gives you a sense of the organization's financial health. And so when we move into the second half of the semester after the midterm, and focus on the final project, which is analyzing a nonprofit, a lot of students will grab the 990s because they're so readily available. The audit is the other options that's performed annually. And so let's just kind of go through some of these things. So first thing is, when you open up an audited financial statement, you want to make sure that the first 3 words in the letter from the auditor says, "We have audited," because not the majority of financial statements you're going to see from an organization, if they are presented as an audit, it's going to be an audit. But there are also other situations where a nonprofit may not get a full-blown audit. So let's just kind of go through this. So an audited financial statement is what's giving you the highest degree of assurance for your investors, for the people who are reviewing your audit, right? So the measure when the auditor says fairly presented is that there's basically less than a 5% audit risk that the financial statements are materially misstated in some way, right? So basically what the auditor is saying is like, look, we've gone in, we've done a whole bunch of testing, right? Audits are a pain, but they're important. So for example, at Lifelong, our auditors so Lifelong ends June 30th. By August 1, the auditors are starting to collect information from us. And they generally will complete the audit end of November, right? So you're talking about roughly 4 months where you're working with the auditor, they're doing a bunch of testing, they're asking a bunch of questions, they're reviewing your policies and procedures, right? They want to make sure that you've got the correct checks and balances, the correct segregations of duties, the correct accounting entries, so that they ultimately can provide their what's called a clean audit, and says that, look, the information that you're reviewing here, we stand behind it. We think the information is presented fairly, so you can trust this data. So the audit is really the gold standard. The next level down, and what I want to be clear is, it's a big drop, but the next level down is something called a review. And reviews provide a much lower degree of assurance than an audit. So, the auditors may ask a handful of questions, but they're not going to dig into the level of detail as part of an audit. Generally speaking, a nonprofit will prepare a review for 2 primary reasons. One is they're not required to prepare an audit, and 2 is the reviews are a lot less expensive than an audit. So, I've worked actually in the for-profit space. I served for 10 years on the board of Zachary's Pizza, which was really fun for folks who like Chicago deep dish pizza. I got to work the kitchen one day, which was terrific. That was a very fond memory. But we did a review with the organization. They weren't looking to acquire debt at that time, but the board just wanted the organization to go through the process and to ensure that the organization was kind of working through the generally accepted accounting principles appropriately, which of course that they were, but it didn't make sense to spend all that money on the audit. So, that's an example. And then the lowest degree of assurance, and I've seen one of these in my 20 plus years in nonprofit finance, is something called a compilation, which is basically nothing more than an auditor taking your internal financial statements and representing them in the form of an audit, in the same form, but there's no assurances there. And quite frankly, it doesn't make a lot of sense in my mind for an organization to present a compilation. So any questions on this, but I do want to go through it. Just make sure you understand that sometimes you'll see a review. Most of the time you're going to see an audit, but I also want you to understand, kind of the purpose behind an audit and what the value of that is. Okay, let's keep going. So we talked about some liquidity indicators. Let's just do a quick review of these and make sure folks are good on this. And we'll start going through some exercises in short order. The key metrics for liquidity, and some of you may have done some of this on Gotham case. It was not expected, but you could. How many days of cash on hand or months of cash on hand, right? And this is just a measurement of your cash position on the balance sheet, which is the numerator, and then the average monthly or average daily expenses as the denominator. And generally speaking, the metric you want to kind of hold is that a nonprofit should have at least 90 days of cash on hand. That's the general rule of thumb. Now, does anyone know, generally speaking, where most nonprofits hover? It's not 3 months of cash on hand. On average, nonprofits are right around 2 months of cash on hand. So not terrible, but that's tight. So nonprofits that have 3 up to 6 months of cash on hand puts them in a much stronger liquidity position. Going back to what Harry mentioned at the beginning of class, right? You know, the nuts and bolts of the business are driven by cash. Cash is the oil that keeps the engine going. So you want to make sure that you're where you need to be in terms of a healthy cash position. Current ratio, as I've mentioned in previous classes, is what keeps your months of cash or days of cash honest. This measures the ability to pay your current obligations. So in other words, how many times over can your current assets cover your current liabilities? Who remembers what a current asset is? Gabriella?
Those are assets that can be cash within 12 months.
Correct. So it's either cash or things easily convertible to cash within 12 months. So outside of cash, what's the other big line item that you would typically see under current assets? We've been talking about it most of the first half of this class. Very Gotham.
Accounts receivable.
Accounts receivable, exactly. Right? Accounts receivable is, this is money that we haven't collected, but we expect to collect certainly within the next 12 months. There are long-term accounts receivable out there, but the vast majority of accounts receivable are going to be current assets. So if that's what current assets are, things that are cash or easily convertible to cash within a 12-month period, what's a current liability? Gabriella again, go for it.
Liabilities to be paid within 12 months.
There it is, right? And so a good example of that is your accounts payable, right? What you owe your vendors, you're going to need to pay that certainly within 12 months. So the current ratio is basically saying, how many times over can your current assets cover your current liabilities? And ideally, you want to have a minimum of 2, and you want to go up from there. Now, when I say current ratio keeps months of cash or days of cash honest, anyone have any idea what I mean when I say that? Current ratio is what keeps your months of cash or your cash honest. Let me ask the question a different way. If you have a really healthy cash position, but a really lousy current ratio, what might that mean? Jessica?
It could mean that you have a lot of cash, but you're not paying out your obligations.
Yeah, that's exactly right. So sometimes organizations will juice their cash position by not paying their vendors. And if you're just looking at days of cash or months of cash, you're never going to see that. But if you track these two ratios together, that's going to give you a pretty clear, kind of a bulletproof, well, I don't want to go that far, but it's a strong indicator of the organization's liquidity health, if you will, because it will help you understand both where you are in terms of your cash, and then is there any risk associated with the cash being overstated as a result of owing a bunch of money in the short term that you just haven't paid out yet. Is that clear? Are there any questions on that, Perry?
Yeah, I was just wondering, is there any like, and I bet it varies from like organization to organization, but if an organization has a board mandated operating reserve,
Yep.
is that functionally different from cash on hand, or does it just really depend on how that's like structured in the bylaws?
Ooh, that's a really good question. All right. So let's just take a quick second, talk about a board designated reserve. So Perry, just because you brought this up, are you familiar? Have you worked with an organization that has a board reserve?
Yeah,
Okay. And how does that work for the organization that you're connected to?
we were required to have, I think, at least 3 months of like operating cash on hand, or in a reserve to be able to pay for that. I think it was implemented after COVID.
Got it. Smart. Okay. So a board designated reserve means that the board is doing a carve out of its cash and putting it into a reserve fund that is overseen by the board. And the key word that Perry brought up is designated. Designated is not the same in the nonprofit space as restricted. Those actually mean two very, very different things. Restricted funds are donor imposed. So it is an outside entity that is making a declaration for how the organization can and cannot use those funds. And if the organization chooses to accept those funds, those restricted funds, then they're basically agreeing to what the donor has imposed on the organization. That's restricted. Designated means the board, as Perry just described, is designating a set aside. And what that means is the board designates, the board can also undesignate. But they're basically carving out these dollars for a specific purpose. This is really assuming that the organization has enough cash on hand to do this. This is a really good practice for organizations because it's a way of describing, if anyone asks, the purpose or purposes for which the retained earnings or the accumulated surpluses are intended, right? Because how do you build up your cash position? It's through surplus, right? And so if you're sitting on a 90-day cash on hand, right? Sometimes a funder will come, I've had this happen, right? Where a funder will say, well, we'd like to support your organization. We love the work that you do, but we also notice on the balance sheet, you've got like 6 months of cash. So why are you sitting on all this cash? Why is that on the sidelines? Why is that not being put to work? We've got 100 other deserving organizations out there. If you guys have enough cash on hand, maybe you don't need our funding. That can happen. And so what's the response to that? Well, the response can be, well, yes, but we have a 3-month reserve fund that's been established for the following purposes. So here are some examples of those purposes. And I realize we're deviating a little bit from the ratio analysis here, but this is important and valuable stuff, right? So one of the most important is a building reserve fund, right? And whether you own a building or rent a building, there's always going to be some kind of deferred maintenance, right? So, you've heard me mention this before. Lifelong, again, healthcare has been where I've spent a lot of my, effort and energy over the last really 15 years. Before that, I worked with a much broader group of nonprofits across subsectors. In the healthcare space and in a lot of other subsectors in the nonprofit space, the building is an integral component of service delivery, right? So the perfect example, is the HVAC systems. There is nothing less interesting to a funder, I think, than an HVAC system, right? I would love nothing more that if you're going to restrict any dollars, restrict it to the HVAC system, right? If somebody wants to put their name on something, put it on the HVAC system or the boiler room. It's never going to happen, but that's my personal opinion, right? But the HVAC system, right, the heating, venting, air conditioning, doesn't seem particularly interesting or important unless, it's 104 degrees because you're in a heat wave and the HVAC system conks out. I can tell you firsthand that the patients aren't happy and your employees are extremely unhappy. And so does that affect mission delivery? You bet it does, right? So the board designated reserve is saying, hey, look, we're setting aside dollars for emergency capital investments, right? That's a pretty legitimate reason for why you're setting up those reserve funds. The other, and Perry, I think this is probably tied to what your organization has done, is a rainy day fund, right? We live in an uncertain world. Funding sources may go away, and we want to make sure that we have enough runway to continue operations if, the federal government takes on these draconian measures to try, just as an example, right, to claw back dollars or to reduce funding that, we've always relied upon. Another good example. And there are others as well. Questions on that? Okay, the other liquidity measure here, again, ties to Gotham as well, is days receivable, right? This is just looking at how many days worth of receivable does the organization have. And this is just looking at your accounts receivable, what you have, multiplying it by 365 and dividing it by your annual operating revenue. And that will give you a sense of how many days worth of accounts receivable you have. And generally speaking, you want to stay within 30 days. That's considered healthy, right? That means you're collecting, think of Gotham, you're able to collect on average accounts receivable within 30 days. Some may be more, some may be less, but on average, that's where you're sitting. Okay. All right. The other ones that we've talked about, net margin. This is a profitability metric. In the for-profit world, you're looking at sort of the net profit or surplus or deficit divided by revenue. Sometimes for nonprofits, it's actually better to look at total expenses. As you've heard me mention before, the unrestricted change in net assets is the column that you want to go to first because that gives you the best picture of how the organization performed. So all the net margin is doing is giving you a look at the magnitude of the surplus or deficit, right? So if I said to you, hey, this organization ran $1 million loss, is that a lot or is that a little? Well, if your organization has a budget size of 5 million, then that $1 million loss is a 20% negative net margin. That's kind of scary, right? If you're $100 million, $1 million is just 1%. It's effectively break even, right? So the net margin is going to show you that magnitude and kind of help you understand how dramatic the profit or the loss is. Last one here is capital structure. We're not going to spend a lot of time talking about this, but this is looking at sort of the liabilities and net assets on the balance sheet. It's a way of measuring leverage. Debt to equity is one measure that it's kind of a blunt instrument, but it's a good start, which is the liabilities, right? What you owe divided by the net assets will give you a sense of is the organization in any way potentially over leveraged. Generally speaking, when you're dealing with capital structure, you want to look at the covenants in the loan documents and basically track those covenants. So debt service coverage is one, debt to assets or liability. There's a number of different ratios that you can use. Okay. A couple other things I want to go through. I want to pivot onto something else. I want to go through a couple exercises reflecting on what we've covered last week, and then we'll take a break. A little more content after the break, and I also want to talk about ACCI. Can folks see my slide here? Okay, so let's just wrap up the 3 financial statements. Samaya, thanks for the floating thumbs up. I like that. So I'm going to ask you all to take 3 or 4 minutes and complete 1A, B, C, and D. But let's first talk about the statement of activities. Can someone walk me through the statement of activities? Anyone want to do that? Oriel? Stay close to the numbers. What's the statement of activities telling us?
Okay, so they brought in $252,791 in revenue in 2016.
Yep.
And they spent $202,791 in expenses. And that the revenue minus the expenses gives them the surplus of 50,000.
Perfect. Perfect. Does everyone see what Oriel did? She just literally went through each line, stay close to the numbers, and describe the income statement. That's what you want to do. As I've said before, my Berkeley students oftentimes will sometimes overthink. I'm asking some very fundamental, granular questions. That was perfect. Okay, so the only thing that's really different that you see here as compared to Gotham is that the statement of cash flows is using something called the indirect method, which means is they're taking the surplus and they're backing into what the change in cash is by backing out any additional accounts receivable that's shown up on the income statement, right? So the statement of cash flows is still doing the same thing. It's reconciling, excuse me, sources and uses of cash. So please answer 1D first, and then you can back into 1A, B, and C. Just take 2 minutes, work on it independently, and then we'll talk about it as a larger group. And I've just got a couple more of those as well. Okay. Okay, everyone. So let's start with 1D. What's the change in cash?
$23K.
23,000. Okay. And so you got 23,000 because we started off with a surplus of 50,000, and then the change in accounts receivable, right? We're reconciling for change in cash. So there's $27,000 that we're taking out of the surplus because it's accounts receivable. That leaves a $23,000 change in cash. So if with the 23,000 change in cash, what did cash increase or decrease? Elias, what do you think? Did cash increase or decrease from the beginning to the end of the period?
It decreased.
Nope. It increased, but why? Toby, why did cash increase?
Cash increased because it was the cash from the beginning plus the change in the cash.
Perfect. That was such a great answer. And so what did you get as the ending cash balance?
73,000.
73,000. Okay. So same question for someone else. Did accounts receivable increase or decrease?
It decreased.
Nope. It increased.
No.
Why? Somebody want to give a answer as to why AR increased? Let's look at the answers here. Right? So cash went from 50,000 to 73,000. Accounts receivable increased by 27,000. Why? Why did AR go up? And by the way, folks, this is this is one of those wonky things on when you're using the indirect method on the statement of cash flows. We're not going to get in any more detail than what you're looking at here, but I want you to get a feel for this. So, it's counterintuitive when you see the negative sign and the change in AR and the accounts receivable is going up. Does anyone want to try to explain why that's happening? Sanaz?
Is it because you earned the revenue, which we could see in the statement of activities, but you haven't actually collected all of it in cash yet?
Exactly right. So remember what the statement of cash flows is doing, right? It's reconciling the change in cash. So you're starting with the surplus, which is coming from the statement of activities. But the next question basically is saying, look, of the 252,000 in revenues, did we receive all of that, or was any of that earned but not yet received? And if so, how much? And the statement of cash flows gives you the answer to that question. It's saying of the $252,791, $27,000 was earned but not received in cash. And so if it wasn't received in cash, you need to back that out because you're trying to get the change in cash. And by the way, the statement of cash flows in a typical financial statement is going to be much more involved than this. But this is just kind of giving you a flavor and a feel. And so as a result, what's happening is your accounts receivable is going up. Don't hate me. I'm just trying to give you a sense of how these things work together. Are there questions on this? Is there a need for more clarity? Perry? And then Sumaya.
Yeah, I did have can you explain? I think you mentioned last class that it is just because we haven't received the money yet, is that why it's counted as a liability before? Because they could, it could not come through.
Sorry, when you're ask me the question again, I didn't fully follow that.
For the accounts receivable, like we're backing in the statement of cash flows.
Let me just back up for 1 second. Accounts receivable is an asset. It's not a liability. So,
well, I guess what I'm saying is functionally, are we backing, is the reason that we're distinguishing the cash because the accounts receivable could be a liability if we don't actually receive it?
Yeah, so you're asking a really good question. So the answer to your question is no, but let me explain why. Okay. So you have to look at what the statement of cash flows is designed to do. The statement of cash flows is designed to reflect what the ultimate change in cash is for the period. In this case, it's for the year, right? So think of this from a personal example, right? So let's say that, on your personal income statement, Perry, you generated a $50,000 surplus, right? But when you're looking at that $50,000 surplus, you're like, but wait a minute, I've got a $50,000 surplus, but I've only got an additional $23,000 in cash on the bank. Why is that? And the answer to that question is that we have customers that owe us $27,000. And so that's where the other part of that $50,000 surplus is coming from. It's the money that the customers still owe us but haven't yet paid us. Does that make sense? Does that help clarify? Awesome. Someone else had a question. I can't remember who now.
It was me.
Sumaya. Yeah.
Yeah. Just a quick question, notation wise, are you putting the minus in front of the AR just for us to do the math better, or on statements is it actually listed as a negative balance?
Yeah, no, when you look at the statement of cash flows, you'll see that it'll be in parentheses, but it's the same thing. So it's basically saying on the statement of cash flows, what is increasing cash or what's decreasing cash. And in this case, because the accounts receivable has gone up, that's always going to decrease cash.
Okay, so it's the inverse.
Yeah.
Okay.
Cool.
Thank you.
All right. Let's see. I'm going to skip depreciation. Let's take a break. I'm going to come back to these questions in the future. So it's 6:20. Let's take 10 minutes, you guys, and we'll come back at 6:30. A couple other pieces of content, and I do want to go through the Aki case as well. All right, so I'll see you all in a few minutes. And then give me one other quick second here. Perfect. Okay. So I want to take a few minutes and just start to talk a little bit about budgeting. We'll pick up some more of that next week. And I do want to leave a few minutes toward the end of class to go through Aki case, which will be due next week. And I just kind of want to walk you through that. I also want to mention we have a midterm coming up in 2 weeks. And so let me just take a moment and talk about the midterm first, because I want you to be comfortable with the approach to that. So for the midterm, it will be a open book, open notes exam. We will use the class session in 2 weeks for you all to work on the midterm, but you will have 24 hours from the end of class to actually submit the exam. There will be some definitions and some short answers. And then there will be a mini case study based on the information that we've covered in class. There are no curveballs on my midterm exams. And I say that in part because I just spent a weekend or this past couple days at a baseball tournament in Jupiter, Florida. We're just throwing fastballs right over the plate. Like that's what we're doing. And like 70 miles an hour fastballs. So, what I'm looking for, the purpose of the midterm is to make sure that you all are able to demonstrate to me the fundamental elements of what we've covered so far in this semester. So if you stay close to the slides and the conversation we've had in class, you'll have everything that you need to know. So the terms, the definitions, some short answers, cash versus accrual accounting, guarantee something like that's going to be on there. Reading and interpreting a income statement, guarantee that's going to be on there. Some work on ratios, things along those lines, so that you have an opportunity to demonstrate that you've picked up sort of the baseline fundamentals on how to read and interpret basically the two main financial statements, the income statement and the balance sheet. Okay. Let me just pause there and see if there's any questions. But what I want to reassure you is I'm not throwing you any surprises or any curveballs. There's not some obscure quote in one of the readings that we didn't cover in class. The only things that are going to show up in the midterm are what we've covered and discussed in class here together. Okay. Open book means that you can use the notes, you can use the slides, the information from the class. You're just not, you need to do the work yourself. It's not a collaborative exam. It's an exam you need to work on independently. Sumaya?
When you say case study, are we going to have like an Excel modeling component of that as well, or just like a read and interpret questions?
It will be read and interpret. There will definitely be calculations, but you don't necessarily need to use Excel. What I would recommend is when there are calculations is to show me the steps so that if for some reason the calculations aren't correct, I can at least give you partial credit because you show me how you've done the work. So, current ratio, if you don't grab current assets, if you grab total assets, if I see your approach, I can give you partial credit. If you just give me the ratio without any explanation, I can't give you credit for it. And we'll talk more about it next week, but I just wanted to put in the preview this week. Ariel?
So will we be meeting during the class time in 2 weeks' time?
Yes. So the purpose of meeting during class time is we'll go through the exam together. You don't necessarily have to work on it during the exam during class time, but nearly all students do. Because if there's a question that comes up, I'm available to answer. That's the primary reason. Typically what happens is a third of the class will finish within the first 90 minutes. Another third will finish really within the 2-hour allotment. And then another third will take about 24 hours and submit it at the very end. Sumaya?
Sorry, very much at the scene of the crime of all questions today. For the structure, is it like in Canvas and you can save and like stop and start, or once you start it, do you have to like leave the browser window open? Because I've definitely had both examples before.
That sounds much more sophisticated than anything I'm doing. I will drop a midterm exam in Word document format into one of the files in the folders. And then you open that up and you can work off of that Word document. And
Incredible. Thank you.
Other questions? And again, we'll pick this up. We'll do a little more preparation next week, but just wanted to provide the introduction for this week. Cool. Okay. Okay. So I want to take a couple minutes and just talk about, oh, I think I stopped share. Talk a little bit about budgeting. Again, this is also part of what we'll cover next week. Assuming everyone can see my screen. Okay. So there are different types of budgets. And again, this will just be kind of a brief introduction here if I can figure out how to move things around. So kind of working from the top down, a strategic budget is really a multi-year projection. Strategic budgets are actually, to me, some of the most interesting work that I do in finance, because what we're doing is taking, for example, an organization's strategic plan and really taking the time to work through the underlying economic logic of what the organization is trying to accomplish in that time frame. So the further out you go, the more imaginary those numbers will become. But that doesn't mean that the exercise is invaluable. It's actually extraordinarily valuable. Not so much around the accuracy of what the budget's going to be in 3 to 5 years from now, but how the process really sharpens the thinking of the leadership team around the core assumptions that might be driving growth and change. And folks, I cannot tell you how valuable going through a rigorous exercise on the financial side to really help nonprofit leaders align around what it is that they're trying to accomplish programmatically. Because sometimes the work that you're doing from a mission standpoint is a no-brainer. Yes, let's go forth. But is there an underlying economic logic there? And there may or may not be. And if there's not, that's okay, but it's good to know that before you get into it. So that's a strategic budget. We will talk a little bit more about that. A cash budget is just a cash flow projection that typically works on a rolling 12 to 18-month plan that's looking at cash inflows and outflows. This is a pretty easy budget to put together. You start with your expenses and then drop in when you believe your revenues are going to convert into cash, and then evaluate in any given month whether there are cash shortfalls. There's a template that I've provided in B courses. This is not something that's going to be on the exam, but it's just something available to you. That's also some of what we'll cover next week. There's also something called a capital budget. And I spend a fair bit of time in the healthcare space working on capital budgets. We talked a little bit about this when we went through the depreciation exercise, but a capital budget is a way of planning for the big capital expenditures over the course of a given year, which is different than the operating budget, right? Because a capital budget means these are assets that meet a certain dollar threshold. Typically in my world, it's at least $5,000 and have a useful life over multiple years. So for example, we just put forward a capital budget at Lifelong right before I left, where we're planning to replace a roof, we're planning to replace an HVAC system, and a number of other projects. And we asked the board to review it and then approve that. And it just aligns everyone around what it is that we're trying to do in terms of facility management. Okay. And then the last here is an operating budget. The departmental and the program are just subsets of the operating budget. This is the budget most of you are probably most familiar with, right? And it's just a one-year plan for revenues and expenses that ultimately get approved by the board of directors. So a couple more things on this, and then we'll pivot over to Aki. So the first thing is in terms of operating budgets, it's valuable to approve your annual goals first, which might be, hey, we want to generate a profit, right? But getting clear on what it is that we're looking to accomplish. Establishing a timetable and then working backwards from that. So when does it need to get approved by the board, right? My experience has been that there should be 2 sessions with the board or the board finance committee as part of the budget process. So what I will typically do the at Lifelong and quite frankly, most of the organizations where I've worked, they operate under a fiscal year, which has been July to June. So that means the June board meeting is when the next year's budget gets approved. So what I will do is prepare a preliminary budget in May that's very high level, but kind of lays out the big drivers of revenues and expenses for the finance committee to review. And I do that because I want to build alignment early so that when it comes time to present the budget, we're not getting a ton of pushback and we're not pushing into the summer without a budget that's available. So in healthcare, because so much of it is driven around productivity and visits, that's a key area where, you know, are the visit assumptions too aggressive? Is the board lined up around that? Are we good to go? Like questions along that. And then the last thing I will say is you've got to monitor the budget. And as obvious as that may sound, sometimes that gets missed, but that's the purpose of the budget, right? The purpose of the budget is not to create something that we're sharing with funders. So that's not the only purpose, that's a purpose. But the more important purpose is you're using it for fiscal management reasons, right? We're tracking to see how much variance there is on a monthly, quarterly, and annual basis. Because if we need to course correct, you want to be able to course correct quickly. So let me just pause there and see if there's any questions. And again, we will be picking up the topic of budgets and cash flow management and also preparation for midterm next week. Those are the three main topics that we'll cover next week. Nothing? Perry, you're good? And I'm saying that only because you're just like front and center on my screen right now. Okay. So let me stop share. Let's talk about ACCI. So as I'm opening up ACCI, which was just here, and now it's not. Hold on. ACCI is a little more involved than Gotham. And it's also more of a real world example. And by the way, I'm working on a case study now. It's in draft format. It's going to get published probably later this year, which I'm really excited about. It's more of a financial modeling exercise, but it's looking at opening up a homeless clinic and examining kind of the sort of the key economic indicators of what's going to make it work and some of the internal dynamics that are associated with opening up a new clinic. But that's not ready to go. So you guys are stuck with ACCI this year. But let me share my screen. It's so annoying. Okay, it looks like that worked. Now I just need to come back to it. Here we go. Can you all see the ACCI case? Okay, so one of the things that's going to be important in the ACCI case is you're going to be sifting through a lot of information. Welcome to the real world. There's more data here than you will actually need to answer the case study. So you do need to read the case, but really keep an eye out for what's most important. So one of the things I would recommend is take some time and look at the questions first. So let's go through the questions and kind of, I'm going to help you. Hold on for 1 second here. Okay. So, so the ACCI case is based on, ACCI is an acronym for Asian Americans for Community Involvement. It's a community health center, has a big mental health program, and is looking at expanding as a result of the passage of the Affordable Care Act. And this is circa 2014. So it's time for me to update the casework. But there's some, I think, really pertinent and important questions to consider around growth. So the first question is, when you read through the case, the first question is kind of a give me, but it's basically a way of summarizing what did you learn from the case, right? So what's the core issue that ACCI is facing at this time? What is the broader context that makes this issue timely? And then what are the key facts to be considered in analyzing the case? So this is just a way for you to organize your thoughts around the case. The second question, I think, is pretty straightforward, which is what evidence is there to validate Michelle Liu? Liu was the CEO at the time of Ackey, who is saying that Ackey is in a strong financial position. Please, you refer to relevant charts or graphs to support your answer. So there's information both in the case and in the appendices. But again, you guys think profitability, liquidity. That's what I'm looking for, okay? The third is the double bottom line matrix, which I'll explain in a second, to prepare a matrix of Ackey's programs. Exhibit 4 and 12 gives you the data that you need. And in the case study folder, you will see an Excel spreadsheet that will allow you to fill out the double bottom line matrix. And again, I'll explain that to you in a second. And then the question is, what program portfolio adjustments would you recommend and why? And then the last part here has to do with your recommendations. And in your recommendations, the question is, how do you validate these growth assumptions? And basically what they're trying to do is grow at their flagship building on Moore Park on the west side and also potentially open up a satellite clinic on the east side. And are they ready to do both? To what extent are they in a financial position at this time? And I want you to prepare really the two liquidity metrics that we've discussed. So months of cash and current ratio, and profitability metric, which is the net margin. Ignore capital structure for now. Don't worry about that. Just stay with those two. Okay, can I get acknowledgement? Everyone heard that, so there's no confusion? Perfect. And then the last two is, how might Ackey cover the costs of expansion? Right, so there's costs associated with expanding. How are they going to cover that? And then any other tools or approaches that you feel Ackey would benefit from in terms of measuring its future plans and goals. This is just an opportunity for you to say, you know what, there's a couple other things that I think would be helpful for Ackey as they consider this. Last thing I want to say in terms of the questions is, you can argue that they should grow. You can argue that they shouldn't. I will accept both answers. I want to know the justification for the argument as to why they should or why they shouldn't. And students have done both, arguing it either way, right? So let me pause there. I'll go through the double bottom line matrix before we wrap up tonight, but are there any questions based on what I've covered so far? Okay. So let me go back up to the double bottom line matrix, which is in the case itself, and it shows up here. Okay, does everyone see this? Okay, there's different ways to present this, but basically the double bottom line matrix, the x-axis that you see here, you're going program by program, and you're looking at whether the organization is profitable or whether it's losing money. If it's profitable, it goes into the right-hand side. If it's losing money, it goes into the left-hand side. The y-axis is looking at mission alignment, okay? And the stronger aligned it is, the further up it is in the matrix. The less mission aligned, the further down it is. So if the program is both profitable and central to mission, that's a clear winner. That's on the upper right-hand side. If it's less central to mission but generates subsidy, then it would go down here. If it's both not central to mission and losing money, maybe that's a potential distraction, and you might want to think about doing something different. And inevitably, there are always going to be a lot of programs that are in this upper left-hand quadrant, which means they're losing money, but they're central to mission. And the question is, what do you do about it? Okay. Are there any questions about that? Okay, a couple other things to share. There's some data here that shows kind of the patient visits and some other data points and their projected expansions. You might want to look at this and see whether the growth assumptions seem realistic or questionable to you. And then when we get to, sorry for the scrolling, it drives me crazy when people do this, and I'm looking on Zoom here, but I don't know a better way to do it. This is the double bottom line matrix in the exhibit that shows you the overall rating for the mission alignment. there's some heat maps looking at San Jose. But the main thing I wanted to show you is here, right? This is the balance sheet information. And this is the income statement information. You are welcome to, and this is an unusual presentation, but it includes unrestricted and temporarily restricted things like cash. You're welcome to use the total. You can use unrestricted, it's up to you, but just state what you're doing in terms of preparing the ratios. Okay, and you have 1, 2, 3 years of that information. Let me pause there and see if there are any other questions. You are welcome to work in groups. I would recommend it. Again, I am not looking for a heartbreaking work of staggering genius. This is not a literature course. Bullet points are fine, but I want to make sure you are clearly and succinctly answering the questions, and that the recommendation as to whether they should or should not grow is based on the data that the case is providing. Okay, and again, this will be due, we'll go through it together next week, but the case will be due before class next Thursday. Okay. I actually went through that faster than I expected. Y'all didn't have any questions. Nothing else? All right, you guys. I think you get to buy 4 minutes back. I like never do that, but you get 4 minutes. If there are any other questions, please let me know. Ben, are you still available? Do you want to take a few minutes afterwards and meet?
Yeah, thanks.
Okay, perfect. We'll do that. Folks, have a great week, and I will see you on Thursday. If there are questions about the case, please let me know. And again, uploading it onto B Courses, 1 submission per group is fine. Make sure you put everyone's name in. Thanks, y'all.
Thanks. Thank you.
Thanks, Brent. I wasn't sure if you saw my chat or not.
I did not, but I
okay.
we were planning to meet.
You remember. Okay, awesome.
Hey, Brent.
Yes.
I know we scheduled some time to meet after class as well. I don't know if you're still available or not, but we can.
No. We can definitely do that. Which one of you would like to go first? I'll put the other one in the waiting room, and then we'll switch.
Mine's not urgent, Gabriella, so if you want to go.
I don't know how long mine will take, so
Okay.
You should go first.
All right, thank you.
Samuel, I'm gonna start moving people into the waiting room. We've got a few people here who are videos are off or on mute. Does anyone have any questions? Okay, I'm gonna put folks into the waiting room here. Oh, hold on.
Thanks, Gabriella.
Ben, you're going first?
I think so, yeah.
Okay. And Gabriella, I will as soon as I'm done with Ben, I'll bring you in, okay?
Sounds perfect. Thanks.
Awesome. Thanks for your patience. Okay. Ben.
Okay. Hey, I'll try to go quick. But definitely getting the feeling like I'm falling behind and not interpreting things as well. So gonna require more attention on my part, but I wanted to make sure I'm caught up with the Gotham case in particular. Is it helpful if I share my screen?
Sure. Yeah, go for it.
Okay.
You able to share now? I got a request.
Yeah, there we go. Yeah. Okay. You can see this sheet, right?
Yep. Income statement looks correct.
Okay. Yeah. I think so the case data, obviously that's good to go. Income statement, I'm good with. Revenues and expenses. Surplus is just the difference between those effectively. Accounts receivable, I think I'm all right on. I'm not sure if the numbers were right on my end. But I mostly, it's not the number so much. I just want to make sure I'm interpreting what these values and how we got them are.
Yeah, so there's a problem for sure.
Mhm.
And the problem is, so go down to the statement of cash flows.
Mhm.
So what's missing is you get the net cash from operations, which is okay, but you don't have the beginning and the ending balance of cash.
Right.
That's a big miss.
Yeah, I was totally lost on that. We submitted it correctly because Bruce is great at this,
Okay.
but on my end, I was lost.
Yep. So the beginning cash balance, let's work with October. So the beginning cash balance, if you go to that cell, that's zero, right? It's a new program.
Mhm.
And then the ending cash balance is just the beginning cash balance plus the net cash from operations.
Okay.
Okay. And then the beginning cash balance in November is just the ending cash balance from the prior month. And then you're going through the same process, right?
Mhm.
Yep.
Yeah.
And so then, yep. So that's going to be zero.
Oh, just zero. Okay.
Yeah, just
Oh, right. This is zero because we started. Yeah. Okay. And then this is
net cash from
C.
operations. Yep. Plus whatever the net cash from operations is.
Okay. Okay.
And then drag both those formulas across.
Mhm.
Great. And then the cash balance on the balance sheet is equal to the ending balance for the month.
Cash balance, cash on the balance sheet is equal to the
Yeah.
ending balance for that month.
Yep. Because that's the ending cash balance, right? So that's where
Yeah.
your cash position is at the end of the month. So when you set
Yep.
those two together, that should reconcile. I think everything else looks okay.
Oh,
So
so I have this set to net cash from.
that's the big miss. That's your big miss. So set it equal to the ending cash balance. Yeah. And then drag it across and let's see what we got.
Okay.
Something else is wrong.
Oh, this isn't right. This line, right?
Net cash from operations.
Yeah.
Yeah.
This is we're losing cash.
Well, you should be losing cash, but yeah, let's go. Here's what I would do, Ben, rather than try
Yeah.
to have this in real time. Let me look. If you want to send me your spreadsheet, I'll review it with you. Or what you
Okay.
can do, actually, better yet, since Bruce got it, go look at his spreadsheet and see where the miss is, and then let's connect next week and
Okay.
get some more time to go through it. This isn't going to affect you on the midterm, but I appreciate you really wanting to understand it. So I'm more than happy to take some time and go through it together. But look at his spreadsheet and see what he did that's different than what you did, and see if you can make sense of it yourself, because that'll be a helpful exercise for you to learn. And then whatever open questions you have, we can go through it together.
Okay, that sounds good. Yeah, I want to understand how they're talking to each other and how to interpret the lines, like the growth in the lines and et cetera. So it's more about that and less about like I just want to make sure I got the numbers correct. But I will look at Bruce's. Can I ask you one more thing about inventory? This is the cost of the value of our inventory, not the number of item like frozen meals we have.
That's exactly right. And that's sometimes
Okay.
where students will get it missed is I'm not looking for an inventory count. That is something that you do, but not in finance. I mean, not in the financials, right? So
Okay.
we want to see what the inventory count is. But here we want to know what the dollar value is, which is a multiplication of the number of items times the unit cost.
Right. Right. Yeah. Okay. That makes sense. I'll connect with Bruce and then email you so we can chat next week.
Perfect. All right.
All right.
Yeah.
Thanks, Brett. Have a good night.
Yeah, you bet. Thanks, buddy.
Hi.
Hi. Okay, perfect. I'm working off of my laptop and an iPad here, so it was a little tricky navigating those things tonight. Um, so what's going on? How can
Well, I actually have a couple of questions.
Sure.
One is like very, very unrelated to like the main thing I emailed you about, but it's very quick. So I was in the Impact CFO
Oh, good.
like
Oh, great.
info
Wonderful. Yeah.
section. And I'm really excited about the program in general.
Perfect.
And I've been chatting with a couple of the staff members from CISL. And my main question is, what is the difference between your MBA course and the one that we're currently in?
Oh, there's a lot of overlap. The main difference is what we spend 3 weeks doing and learning. In the MBA class, we cover in like 30 minutes, right? Because what I'm assuming with the MBA students is you, there's a knowledge of a balance sheet and like all the stuff. Like I don't teach Gotham. Like when I have taught Gotham in that class, we do it in 20 minutes. So it's more like it's just sort of like a condensed, accelerated version. We spend less time learning how to read. I mean, there's still reading and interpretation, but it's more like what are some of the specific nuances to nonprofits that's different from what you would see in the for-profit world. Yeah, so it's just kind of a more accelerated, condensed program, right? So I'm not explaining what an asset is. I assume that everyone in the class, so sometimes I have students from outside of the business school
Yeah.
and they will get overwhelmed and be like, and so usually what I'll do in the beginning, I'll just say, look, I'm pacing this for the business school students. And if you're overwhelmed, then, come talk to me. But it's a great class. I mean, it's really fun. It would definitely be a repeat of a lot of the content we've gone through.
Okay, cool. Good to know. Good to know.
Yeah.
Regardless of, I sent in my application for the Impact CFO program, but whether or not I get it, I'm still trying to map out my elective schedule anyway. So I kind of wanted to know if there was
Sure.
a
I
need
mean,
to
I would
take.
love for you to come join it again. I just want to make sure you would find
Yeah,
out in learning
sounds
that.
good. Cool.
Yeah, it's a fun. I mean, it happens over 2 Sundays. It
Yeah.
has to be really dynamic. I mean, it's hard to believe, but I've been teaching for 15 years, and as long as the students enjoy the classes, which at Haas I've always been in sort of the high club six, like they find a lot of value in it. So I'll keep doing it.
Yeah.
The second they stop finding value, that's when it's time for me to go with something else.
Well, I've really enjoyed the class so far, so
Okay.
I'm pretty excited about it.
And I'm so sorry. Remind me of your other question. I'm not.
My other question is around the budget for the nonprofit that I currently work at, actually. And I wanted to get your thoughts, and I think some of the slides you shared today might help point me in the right direction. But our fiscal year is January through December. So we're currently in the process of doing 2026 budget planning. And we have grown a lot in the organization as an organization. So in 2024, kind of last quarter of 2024, we moved into a big, beautiful, brand new building. And so our operating expenses have changed drastically. And our board is now finding that kind of our old budget model isn't quite what they're looking for anymore, and that we've kind of outgrown it. So I can share my screen if that's helpful. Okay, this is our our current budget. Is it showing?
It's working on it. It's trying to share.
It's working on it. Okay.
As soon as it comes up, I'll let you know. It says it started screen sharing, but I don't see anything yet.
Let's try again.
Oh, sorry. Hold on. This is recording.